Look at the empty storefronts in your neighborhood. The local Italian spot on the corner hasn't just gone quiet, its physical footprint is being erased by the flicker of a delivery tablet. In the commercial cores of our cities, physical hospitality is being overwritten by digital logistics. Statistics Canada reports that the food service industry reached a record $101.4 billion in sales in 2025. This chart compares $100 billion revenue growth against a net business growth rate of exactly zero. Closures equal openings. The money flows, but underlying infrastructure is stagnant. Revenue distribution has shifted. Limited service, delivery-optimized entities now command 46.6% of the sector, officially overtaking full-service dining. Boarded-up windows and for lease signs mark the physical consequence of this algorithmic takeover. The economic premium of a prime street corner has been severed from physical real estate. The rent once paid to local landlords has relocated to Silicon Valley servers. Independent chefs are being demoted to digital tenant farmers, operating on territory controlled by faceless platforms. This structural shift is the result of macroeconomic traps set years before the 2026 phase shift. In 2020, the federal government distributed $60,000 CEBA loans to keep small businesses afloat. That lifeline became an anchor. By 2026, those operators were hit by a stagnant 1.1% national GDP growth, colliding with the 12.3% spike in the Consumer Price Index for restaurant food. The Bank of Canada maintained high rates to combat inflation, transforming the 2024 CEBA repayment deadline into a terminal event for thousands of operators. Businesses entered a state of the walking dead. Owners liquidated their physical dining rooms to pay the CRA and moved their entire operation into windowless industrial pods. This chart from the Superintendent of Bankruptcy reveals an anomaly. Food sector insolvencies dropped 13.4% in early 2026. This indicates traditional kitchens have already been purged. The remaining sector consists of an industrialized survivor pool. The industry survived its debt trap by sacrificing physical hospitality. We can examine the extraction process through the micro-unit economics of a single digital order. Regulatory attempts to protect restaurants, such as the British Columbia Food Delivery Service Fee Act, provide a case study in these mechanics. The Act establishes a 20% cap on what platforms can charge restaurants for core services like ordering and delivery logistics. A loophole in the legislation permits platforms to charge unlimited fees under the banner of enhanced services. This receipt graphic illustrates the visibility tax. Platforms charge an additional 10 to 15% for marketing. Delivery, service, and small order fees stack on the consumer side, inflating the total while the kitchen's share shrinks. If a restaurant owner refuses to pay for these enhanced services, the algorithm pushes their menu to page 10 of the app, effectively ending their visibility. In 2019, a traditional physical lease cost 8 to 12% of revenue. By 2026, total digital rent extracts up to 40% of a business's top line. Consequently, net profit margins for independent operators have flattened to 1 to 2%. Today, local restaurants function entirely as high-volume processing hubs, engineered specifically to pay digital rent to a platform. Industry groups claim a labor shortage is the primary bottleneck for recovery, but official data suggests a different reality. Official labor force data reveals the food and accommodation sector lost 7,500 jobs in January 2026, even as digital sales hit record highs. The traditional model relied on the skilled human culinary artisan. Instead, the 2026 structural reset replaces that human artisan entirely with automated ghost kitchens and collaborative robotic systems. The de-skilling matrix quantifies the shift. New hire training times have dropped from over 40 hours for a cook to just 2 to 4 hours for a machine operator. The chef is replaced by a system monitor following tablet prompts. Labor costs have dropped to $1, and success metrics have shifted completely to the algorithm delivery score. The resulting food is engineered strictly to survive a bike ride in a thermal bag. It is a unit of fulfillment. We are de-skilling a generation of workers to satisfy an algorithm's demand for friction-free mechanical efficiency. A measurable consumer exhaustion point is forming against the sterile products and high fees of these windowless hubs. RBC economics data shows a 4.1% surge in hyper-local spending within a 2-kilometer radius of residences. Consumers are returning to physical discovery. In Montreal, the ETA Cooperative Delivery Network has emerged as a primary structural countermeasure. This comparison chart demonstrates the mathematics of the resistance. The cooperative model cuts the 30% platform tithe down to a sustainable 15% utility fee. This model requires treating local logistics as a shared community utility rather than an extractive venture-backed asset. Survival for the independent business requires digital sovereignty, owning customer data and bypassing third-party apps entirely. Reclaiming the physical heartbeat of our cities requires breaking algorithmic control. This same digital landlord model is currently moving into the housing market. Next, we look at how they are engineering the permanent renter.